Hello, this is Chuck Carnevale, aka Mr. Valuation, bringing you another 2-minute drill lesson in valuation. In today's video, we're going to look at BorgWarner, which has lots of valuation lessons to include. First thing I want you to notice with BorgWarner is their adjusted operating earnings are semi-cyclical. Here's COVID, where the company had 2 years of negative earnings growth. You can see that at the bottom of the graph. But then their earnings have been growing pretty nicely since. The problem is when you put weekly closing stock prices on the graph, we notice that the market has been undervaluing this stock for quite some period of time, and that's a concern. However, investment returns come from growth. Right now, we're looking at forecasting growth for BorgWarner to be about 5.38%. That would give us a very strong rate of return if the stock traded at a 15 PE. If the stock only traded at a normal 10 PE, that would still give us over a 22% annualized rate of return. And here's how that happens. That happens from the company growing earnings by this 5.38% amount that's forecast, so that has to happen first. Then we would have the PE ratio expanding from the current 6.67 all the way up to the 9.92 normal PE ratio that the company has been trading at. And keep in mind, that in itself is a very low multiple, but that would give us a 22% annualized rate of return. If it traded closer to a 15 multiple, which I can use my calculator function and basically look at it here, we see that the rate of return could be over 40%, as I discussed before. Now, the other beauty of this stock is it does pay a dividend. That's the white line. If I look at another metric here, if I look at free cash flow to equity, I want you to note that free cash flow to equity, which is the orange line on this graph, is well above the white line here, which represents the dividend. In other words, even their free cash to equity payout ratio is quite low in the 20% range. So this looks like a really strong opportunity. Again, the value is the stock price moving into alignment with the orange line over the next 2 or 3 years, and then generating this 22% annualized rate of return. This is looked as a subscriber request, but it's also looked at as an opportunity for value to return to its norms and generate a high rate of return for shareholders willing to own it for the next 3 to 5 years. The reason why the stock is down is because there's really a little bit of a pall on anything in the automotive industry as it moves into the EV sector. But BorgWarner itself looks like they still continue to have strong fundamentals, and only the stock price is currently weak. They did give light guidance, but the stock market has overreacted to that dramatically.